What's up everyone, it's Caddy with Money Vesting. So welcome on board for another Market Open live stream. We've also got Jerome Powell later today at 10 a.m. Eastern, so a little bit later today than yesterday, so in just about an hour. But the markets here, QQQ is up a little bit over 70 basis points pre-market, so we are pushing higher. We've got the SPY here slightly up over 48 basis points. The Dow Jones is up about 27 basis points. The yields, however, have been coming down, so they're down about 2%. Just trading under 3.1% here. And oil slightly higher, so up over 1.5, 1.7%, so almost 2% in the green, back over 110, 111 per barrel. So a lot of these energy companies which were selling off yesterday are slightly pushing higher pre-market. Not a whole lot, so just about 39, 40 basis points. Exxon is up, Chevron here pushing up over 23 basis points. XLE is also up over 35 basis points right now. Bitcoin is up over 3%, so back over $20,000. And Ethereum also back over 1,100. So, are you trolling us with a thumbnail pic? What is the thumbnail? I don't know. Let me just check. What is it? So, Powell's speech. No. What's the big troll there? We got Jerome Powell in the thumbnail. We got live. Kevin, what are you talking about? It's just a regular thumbnail. No trolls. But yeah, we got Jerome Powell later today at 10 a.m. TRD Mike what thumbnail do you guys see? Is there really a red mic? What? No, what thumbnail do you guys see? Is it for this live stream? Do you really see a thumbnail with a red mic on it? Because on YouTube, on my end, it doesn't show that. Unless I'm looking at something else, I don't know. But the one that I have is just Powell's speech and Jerome Powell there, and yeah, that's it. Just $2 boxing gloves and Jay Powell. Okay, good, Oscar. Thanks for mentioning. I think it might have been for the other thumbnail, right? For the summary video, which it's a 2 hours and 45 minutes. Spent a lot of time listening in on everything. Most of that we covered during our live stream. I think we were talking about this for about an hour. And then I spent another an hour and a half, an hour 45 minutes listening in on the rest of the meeting. And man, I mean, the main topic of discussion is obviously inflation. I think inflation is the primary concern. Obviously, with all the senators grilling Jay Powell on inflation, and it is. There's always a mix of feelings when you listen in on these congressional meetings. Testimony from Jay Powell. There's feelings of just from Jerome Powell's standpoint, just feelings of awkwardness. A lot of questions being asked about fiscal policy, which is not really his area. But at the same time, feelings of pointing blame to Jerome Powell. Kind of feel bad for the guy sometimes. And then they can also be very, very funny as well, right? In terms of the questioning and the types of answers. And there was a point where Jerome Powell said that we're not even doing our job well, so we can't advise you on what to do. We need to get our house in order first before we can even advise you on fiscal policy. So, sometimes it just gets really, really heated. That's what it's all about. It's completely different setup from the FOMC meeting where we've got publications and of course news media anchors asking questions, a lot more polite. But this one is just, absolutely brutal. And again, we'll listen in about 50 minutes here. This is day 2 of Jerome Powell's testimony. I shared the overall economic report, which is about a 70-page long document. If anybody wants to read that, feel free to do it. But James asks, green day today. So, I've already mentioned that this week, just from a technical standpoint, I'm a little bit more optimistic and bullish for this week overall, just given how brutal the last couple of weeks have been. And yeah, we also had a trade idea on QQQ and TQQQs for this week. For this week, the NASDAQ, I think, is more or less just flat here right now. It is, actually this week it's up over 2%. So NASDAQ is indeed up 2% this week. Right now, pre-market's up over 95 basis points. And SPY is up a little bit over, is up over 2.33%. So Oscar says, bro, no one is reading that 70 pages. That's why your recap video was so good. Yes, I appreciate that. And thank you for saying that. But, if anybody's interested, obviously not everybody's going to go through 70 pages worth of information or 3 hours worth of content listening in on what every senator said. So again, I tried my best to summarize this as much as I can, but this is, for anybody who wants to go that extra route and do some more digging, kind of read those reports. So it's always available, right? Not saying that everybody will read it. It's just, making that available so that people who are interested can read it. So, Kevin says, I'm going through it now. It's a painful read. Wait, Oscar, are you saying that I need to get a life since I'm going through these reports and I'm reading so many pages and I'm going over all this content? Like, I don't... No, that's true. I don't have a life because I'm mostly digging into these reports here to see what they have to say. But anyway, let's just go over our poll. Let's just do this, see where the sentiment is overall. Wait a minute. I just need to end this poll. Got started up. And, all right. YouTube's a little bit slow today. I don't know what's going on. All right. Markets today. You got green, red, flat. All right. So let me know what you guys think about the overall markets. And, this is the divergence that I showed you guys in my yesterday's video. Kind of interesting. Even today we're seeing the NASDAQ ETF push higher a little bit more than SPY or Dow Jones. SPY is up 30 basis points. Dow is up a little bit over. Actually, SPY is up 63 basis points, and the Dow is up 30 basis points. And the NASDAQ ETF QQQ is up a little bit close to 1%. So, definitely seeing a little bit of a much better performance from QQQ versus the S&P 500 ETF. And I think this was a very telling chart that in March, in those 2 weeks, we saw the NASDAQ outperform or do really well, push higher. And then we came right back down to make a new lower low. And then more recently, we've seen kind of like the energy sector, utilities, and more of the value-oriented names sell off pretty aggressively, bring down the S&P 500 to a new lower low. And the growth stocks have kind of held up a little bit better. So we'll see what happens. And we also looked at the CPCE, which is the options only, equity only put call ratio, which obviously traded as high as 0.825, and right now it's right back down. So sentiment obviously was very, very weak earlier last week before improving a little bit. So John says it's going to be bloody. Powell just can't shut up. So yeah, I mean, at 10 a.m. we'll listen in for about 30 minutes or so, what he has to say. And again, it's going to be more of a question and answer situation. There was actually some very good questions asked, especially with regards to supply. But, with Jerome Powell, that's one of the things, right? He has to be as vague as possible. He's not going to be super specific. And point blank, there was a question asked about what is your confidence level of the economy not going into a recession, right? What is your confidence level if you were to allocate some type of confidence? And he just says that, that's not our intention. Our intention is not to push the economy into a recession. Our goal is to simply focus on price stability. And it is going to be challenging. Nobody said it was going to be easy, but that's our goal. That's our objective. So, I mean, obviously, you're not going to get very specific answers from Jay Powell. That's one of the best things that he does. Is like tries to deflect a lot of the questions the best he can. Obviously he was asked a lot about fiscal policy, a lot about legislation, which he just didn't want to weigh in on. He just didn't want to participate in those questions at all. And that got really, really awkward sometimes. But that's how these, Powell is the new Fauci. And that's how these congressional meetings go, is that, because you can't just, look at inflation and then talk about monetary policy in a vacuum, because the economy overall is just so complex. There's just so many moving pieces that you need people to weigh in on other issues, even though it's not their area of expertise. Like, even though Jerome Powell and the Fed and FOMC, their primary goal is not about fiscal policy and how senators and congressmen and women basically move legislation and pass bills or whatnot. But they do need to weigh in on these issues, because if they don't, then they're the ones holding the bag with high inflation. If $1 trillion, $2 trillion, these fiscal checks or stimulus and all these bills keep getting passed, eventually that's money going to flow into the economy somehow, right? Either that's going to be by spending or investing. That money is going to flow into the economy eventually, and that becomes a monetary issue with money supply sooner or later. So I think the structure is a little bit disconnected. Jerome Powell keeps on saying that our job is only to focus on price stability and employment and interest rates and monetary policy and controlling demand, but that's a little bit one-sided of an argument, and obviously doesn't take into account the full picture, full context, which is a big piece of that is supply of money, and of course a lot of that is being controlled by the senators. So Gabriel says Powell already knows we are in a recession. He's working on keeping the USA out of a depression. With the global economy all spiraling in the same direction, it will be very difficult to stop. That's true. And, his job right now, I feel like, is a lot more about calming the markets and the economy because it is a difficult job. You're right, Gabriel. It is a very, very tough job. And, some senators also mentioned that. I think one of them even appreciated to a point where, you're the one to take the fall, Jerome Powell, unfortunately. And it is a very challenging situation right now. And as much as he was asked about a recession, he's not gonna say, obviously, that he did say though there is a possibility of a recession. He did mention that, which we also covered in our recap video. But things certainly don't look too good because he admitted to the fact that he can control the price of food and gas. Those are two things, the prices for he cannot control. Even though rates are going up, it's not going to bring them down. And most of the inflation is coming from those two items. If you strip out food and energy, core CPI, still around 6%. That's the number they're really focused on. And with interest rates going up, they are going to be able to moderate demand for core CPI to come down. But they're also going to be, hurting that part of the economy which doesn't need to be hurt, which is unemployment and GDP growth. So yeah, a lot to digest from those 3 hours. We'll see what he has to say today. It's going to be more or less the same. I doubt there's going to be any sort of new words coming out or any differentiated stuff. But yeah, I think that's going to be for the most part. So upgrades and downgrades. Yes, let's take a look very quickly here. Thanks for reminding me. So Credit Suisse initiates rework as outperform. Goldman Sachs initiating Viva Systems. We got Snowflake getting an upgrade to outperform here. Loop downgrades Leslie's to hold from buy. Cowen names Deckard's top idea. Again, just going over these to understand if there's any stocks making big moves. We can understand that, okay, got an upgrade, got a downgrade, whatever. Raymond James got an upgrade on Southwest. Strong buy, by the way, from outperform. Bernstein reiterates Apple as equal weights. We got Bank of America reiterating Netflix as underperformed, lowering the price target to 196 from 240. Says that there is a worsening macro situation. And they also mentioned that the subscriber churn is going to be much, much higher. And we got MKM initiating O'Reilly, Advanced Auto Parts, and AutoZone as a buy. Bank of America reiterates Disney as a buy. Although lowered the price target to 122 per share. So that's where we are. Citi reiterates Spotify as a buy. And then JP Morgan upgrading Funko, whatever that company is, I've never really heard of. Wolf upgrades MetLife to outperform. And then finally, Morgan Stanley downgrades AGCO to equal weight from overweight. So that's all I've got. Not really any updates overall. I think jobless claims were supposed to come out today at 8:30 a.m. Eastern. I think they were a little bit higher than expectations. And yes, thank you so much, GLS, for reminding everybody. So make sure that you do like the video and the stream if you do enjoy it. And like I said, in about 40 minutes at 10 a.m., we'll tune in on the Senate meeting once again. We'll listen in for about 30-45 minutes. It's going to be more or less the same question and answer session. Everyone's going to be recognized for 2 minutes or 2.5 minutes or 5 minutes or whatnot. And we'll see where we end up with the markets. Yesterday, it was pre-market. We were very much down, so we were obviously red, and then we got bought up intraday a lot. And I noticed that for the entire time that we were listening in on the meeting, on the Senate meeting, I had my mic turned off, right? So this was pretty much like this. So no red, right? No red glowing. And what happened? The markets actually rallied during that time. And then towards the end, when I turned it back on, and then last 15 minutes, when we were talking, the market started to deteriorate once again. And of course, intraday, then we started to sell off towards the last couple hours, and we closed pretty much flat So we'll see. We'll see where we end up today. But Funko is the bobblehead toy that you see everywhere, Caddy. Oh, really? Interesting. Wow. Oscar says, don't worry, I pressed dislike as soon as I got here. Great. Great. I love it. We got to balance out the scales, right? We definitely need to. So, okay, so the poll here, 53% expecting the markets to be green, 31% expecting the markets to be red, and about whatever the remainder was, expecting the markets to be flat. So, more people expecting the markets to be green here. So, not a bad poll. So far this week, we are getting a little bit of a bounce back higher, led by growth in some of the technology names, as suggested by this chart in particular. But it all depends on where we close. And, there's a couple different things to really be watching. We have to understand that the NASDAQ still has a pretty important job here with closing above that 50 EMA on the monthly time frame. So we still have about a week and a half for this candle to close. So this candle is for the month of June. We'll see if we actually do end up closing above or below that 50 EMA, because even during the March 2020 crash, we did breach that 50 EMA, but we didn't quite close below that level. So buyers did step in, and even though you see a long wick to the downside, we didn't close below that 50 EMA. So a close below that 50 EMA would really be very, very important technical shift because it hasn't really happened in about 14 years. So that's something that we really need to pay attention to. And then on the weekly time frame, we've got the 200 SMA. We're just sitting right there. We're literally sitting at the 200 SMA, and we haven't really closed below that level. Even last week, we breached down to as low as 10,500, but then the buyers stepped in to push us back above that level, and we kind of had that doji candle with a lot of indecision. And right now, we're just hanging out just at a little bit over that 200 SMA, sitting at about 11,053 levels. So that's where we are. Both watch it on the weekly and the monthly time frame for the NASDAQ, see where we end up being. 53% voted green, not a big confidence builder. No, absolutely not. Definitely is not. Sentiment's kind of mixed, I would say. Obviously, this has been the worst start for the S&P 500 in over 90 years. So since 1930s, this has been the worst start for the S&P 500. So Pauline says green. So, all right, let's just open up our individual names as well and see how they're doing and if there's any momentum coming in for those stocks here. So do you still believe S&P 500 can touch 3,500 with time going, I don't believe, less and less, as what all is priced in much cover current levels. So I think the S&P 500's next big potential downward move, if there were to happen, would happen after or if and when we get a negative revisions on the earnings. The earnings per share estimates are still pretty decent for 2022. We're still expected to grow by 9%, 10%. We're going to get the third print on the first quarter GDP. I think it's later this month or might be in July. So we're going to get that third print on the first quarter GDP, and then we're going to get those second quarter GDP numbers starting next month. So that's going to be a good indicator of whether we're officially, on a technical basis, officially going into a recession or not. And if that were to happen, then unfortunately EPS, which is the denominator, right, on a price to earnings basis, which is the E in the denominator, earnings per share, if those actually start getting negative revisions, because in recessions, obviously people spend less, yada, 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 and earnings per share drop, PE multiples goes higher, and as a result, the S&P 500 could see its next potential leg down. So I think the next big move for the S&P could come if the U.S. actually officially enters into a recession. Right now, it's all speculation that, we're going to see one in this year, we're going to see one next year. But if there's growing signs of recession and earnings per share gets revised down, then unfortunately 3,500 is a possibility. On the weekly time frame, that's where that 200 SMA is. That's the blue line, and that's also the fib level at 0.5. So perfect fib retracement of 0.5 here on the S&P 500 at 3,500. So that's the level to really be watching on the SPX. Let's take a look at IWM. So IWM here trading below its pre-pandemic highs. So, right now trading as low as 168, 167. So definitely trading below its 2 previous resistance levels, was not able to contain or stay above that support level for very long. So definitely been on a consistent downtrend, this one also, and trading below all the moving averages on the weekly time frame. And on the monthly chart, also selling off pretty aggressively. I mean, it has, big month of sell-off, consolidation for a couple months, then sell-off, consolidation, and then a sell-off. So it kind of has like this staircase pattern where it just drops, consolidates, drops, consolidates, drops. It's just like, on a significant downtrend here with kind of like a staircase pattern. So, we'll keep a close eye on where it ends up on the month as well. For IWM, I do think this, Russell 2000, which is small caps, are one of the most undervalued part of this overall sort of bear market and the sell-off. But we have to really pick and choose, right? It's just which stocks are going to come back from this destruction is the hard part, right? Is the one that we need to really understand which are quality versus which are not, and making that distinction really matters in times like these. And which ones will recover and which ones won't. So NEO, let's take a look. NEO actually has been moving up very nicely. So it's one of the first times it's actually sustainably trading above that 50 EMA. The next resistance we've talked about is about $24. So slowly and steadily we're getting up to that level. So this is the next resistance to watch. I think today, $24 is going to be the resistance. We'll see if you actually do get up to that level, get rejected, or if you get a successful breakout depending on the volume. But that is going to be that level to watch. RSI MACD is obviously getting up as well, because we have seen NEO more than double here. So it has gone up a little bit over 98% from lows of $11 and $12 just back in the middle of May. So in about a month, right? Exactly 1 month, because today, well, a little bit over a month, NEO has doubled. So very strong move, and that $24 is going to be that next resistance level to watch. And I know that I heard there was like a crash or something. Oscar shared that in our Discord. So yeah, that's very, very unfortunate for NEO. But right now pre-market's up a little bit over 2.6%. So we'll see. All right, a minute left till the market open, and about 31 minutes left till we get the Senate meeting back up and running. We'll keep a close eye on the S&P 500 here. The yields are dropping pretty aggressively, so they're down about 2.6% today. So just trading a little bit over 3%. And the Dow Jones here, we're going to keep at the bottom right. And of course, we got some individual stocks. NVIDIA up close to 1%. AMD is up over 74 basis points. We got PayPal up over 64. Google is up a little bit over 0.5%. Apple 1%. We got Meta Platforms slightly up 12 basis points, more or less flat, not really doing much. Amazon's up 1.3, and Tesla is up 75 basis points. Trading is at 713. It got up to that 740 yesterday, but obviously was not able to hold up to those gains, and then sold off after hours. And right now, pretty break even right now. Okay, so here we go. The market is open. And in 30 minutes, again, we'll tune in on the Senate meeting. And we'll take a look at some individual names as well. I'll take a look at ARK and Upstart and all these companies. But let's just quickly take a look at where we open for the indices in terms of those index levels. So NASDAQ opens at just over 11,100. So we're back above that 50 EMA on the monthly time frame. So if you come back here on the NASDAQ on the monthly chart, God damn it, this is just, okay, there we go. All right, so here we are. We're back over that 50 EMA, which is, a good thing. It's very similar to what we saw back in March of 2020. So even though we did get sold off here all the way down to 10,500, we're starting to kind of regain control a little bit on the monthly candle. We'll see if we actually do end up closing above that level or below. S&P 500 opens at 3782, and the Dow opens at just over 30,600 here, up just over 0.5%. The Nasdaq's up over 88 basis points at the moment. And we got lots of individual stocks here, more or less flat, only up about 0.5%. Nvidia's up quite a bit. Apple's up over 1.5%. 137 is actually a resistance for Apple. We'll see if we are able to close above that level or not. Amazon's up close to 2%. Not bad. Tesla is up over 0.5% here. Meta more or less is flat here on the day. And Google's up 64 basis points with the volatility just slightly up over 83 basis points. And we'll keep a close eye on this sort of correlation for the relative chart versus the SPY as well. Okay, let's take a look at Upstart, see where the stocks are trading here. Individual stocks, Upstart is up over 2.6, 2.7%, just over $37. Upstart's obviously been one of the most volatile names out there. Probably the most volatile stock. I don't think we have anything that's, well, AMC and Jimmy might be. They might take the crown for the most volatile stock, but Upstart is up there. Definitely up there. I mean, it's gone up 2,000% from its IPO. Almost 1,700% actually, and then it dropped over 90%, 93%. And then it doubled again from lows of $24. It went up to over 54, so it went up 122%, only to then drop back down over 44%. So it's been all over the place. So Upstart here, up 2%. I do have a cash secured put, as you know, most of our Discord members know, on this stock with the strike at 20. And the expiration's up till January. But the return on collateral was over 28 to 30%. So very, very pleased with that type of return. And of course, if it does come down to a new low at about $20, which is about 46% away, then obviously that put will be in the money and I will get assigned after expiration. So that's Upstart. You know, in my opinion, quality company. Definitely has a lot of work to do in terms of growing their loan volume, because as we enter through a recessionary period, especially their auto loans are going to take a bit of a hit, even though it's a new business for them. I think it was like 100 or 150 dealers that are now using their auto servicing platform, which is the financial services, providing those loans very, very quickly using AI. So they do have some headwinds in front of them, but the valuations come down significantly. That's why I'm really, really excited to own if it comes down to lows $20. So profitable companies, very strong growth in revenues, earnings, very, very good margins as well. So and a good balance sheet too. So that's my take. FTNT, what is that one? Fortinet? That is Fortinet, right? Let's take a look at cybersecurity names here. Okay, so FTNT is up. Okay, so they went through a split, right? I think they went through a split, if I'm not mistaken. Yep, so they just went through a split, 5 for 1. So obviously the stock was trading well in the, $200 ranges, 255 or something. They just went through a split, Lucy, 5 for 1. And they're trading at roughly about $55 a share. So, overall, still in this context. So right here is where we are. God, I don't have that spreadsheet for Fortinet. What was the fair value that we calculated? I forgot what it was. If anybody watched that video, just let me know what that fair value was on cybersecurity stocks. I might have to rewatch it. But it's one of the fewer companies in the cybersecurity space that's profitable. And we did take a look at the earnings per share. We put a growth rate. We assigned a P multiple, and I think the fair value was really, really low compared to where it's trading right now. So we just got to divide that number by 5 and we'll get our new fair value. If anybody remembers that, just, let me know in the live chat. All right, so NASDAQ here, pulling back here on the first 5 minutes, first 10 minutes, slightly down intraday, but still up 0.5% here. S&P 500 is up over 40 basis points, and we got the Dow Jones still up over 36 basis points. So markets overall more or less consolidating right now ahead of Jerome Powell's day 2 of the Senate, and then stocks also selling off. So Amazon pulling back here, PayPal, AMD, Nvidia, Apple, Meta Platforms, Tesla, Google, they're all starting to sell off a little bit. All right, so cybersecurity, Fortinet is the only one that's slightly down. Everything else is very much green. CrowdStrike up over 1.7%. Okta, Palo Alto Networks, Zscaler all pushing up. Let's take a look at energy. So energy stocks doing okay, I guess. Occidental is the only one that's up a lot. And that's primarily because of what? Warren Buffett just keeps plowing money into this stock. So Victor, $92 fair value for Fortinet. Okay, so this was I think our calculation of of pre-split, right? I think it was closer to $92 to $100. I could be wrong, but I have to rewatch my video. But if you do 92 divided by 5, my new fair value would be roughly under $19, which I know is crazy. But they have to really accelerate that growth rate for earnings. And of course, I'm using a very, very lower price to earnings multiple. And at the same time, there's a 10% margin of safety built in. So, those are sort of my conservative analysis when it comes to EPS growth and PE multiples. You can obviously be a little bit more aggressive. You can be moderately aggressive. You can be even more conservative than me. It really depends on what your style of investing really is, right? If you are very, very aggressive when it comes to growth, or you're conservative when it comes to growth, and it depends on how much you're willing to pay. It all depends on person to person and their risk appetite overall in the markets. But as we were talking about, Occidentals up 3%, Warren Buffett plowing in another $500 million plus into this stock as it continues to sell off on this recent pullback. It's down about 21% from its recent high. I don't know. I was trying to do some research on this company. And yeah, it was, the dividend's not like a super banger dividend. It's only like 93 basis points. So like you're making less than 1% in dividend yield. So it's not like one of those traditional dividend stocks for Warren Buffett, but he definitely might see a lot of growth potential in this company. And year to date, obviously it's up over 100%. So Fox, Powell spoke or is about to. He's going to speak in about 23 minutes. So he's going to speak at about 10 a.m. Eastern. We'll tune in on the live stream and listen in. But until then, we're just chilling over here. Look here, says ZIM P ratio is now less than 1. So that can be very much of a delusion. I just want to make sure that people understand that. I've been saying that for quite some time. I've never really owned this stock because I know how attractive it can look on paper. But you have to be very, very careful with stocks like ZIM that may look really good on paper, but you have to understand the real story. Yes, the dividend yield is 61, 62%, but it can really cause a lot of delusion with what's really going on with the business. Yes, it's a great company in the shipping and integrated services when it comes to freight and logistics, and prices really did go up. Spot rates literally went up 10 times during the pandemic, and of course, as a result, they generate a lot of profits. But you have to ask yourself if this is sustainable, right? If this is something that company can do next year or the year after that or the year after that. And if the answer is no, then unfortunately, it's not going to take long until the P ratio comes back up significantly, because their revenue went from about 4 billion to over 10 billion. So that's more than doubling, and the margins absolutely expanded, like from 517 million to over 4.6 billion. So 10 times growth in their profitability, and margins went from 12% to over 44%. So it's an insane amount of growth. And I understand, that there's going to be a lot of, there's going to be some sort of value there for ZIM, but what's the fair value, right? So I'll do like an updated video on this. I did a video maybe a month ago or a couple months ago, but I'll do like an updated video on ZIM moving forward as well. Okay, Facebook PE is in the 11s. Yes, Meta's PE is very, very low. Same thing with Google. I think Google is also trading at a very low PE. PayPal's trading at a really low PE. AMD's trading at a really low PE. Tesla's and Amazon's trading at about at an okay price to earnings. They're both trading at about 38 to 40 on a forward basis. Meta is in the 11s. We got Apple now about 20. Nvidia, I believe, is in the 25 range. AMD's come down to about 16. PayPal's come down to 14, 15 on a forward basis. And Alphabet, Google, also trading in that 15 to 16 range on a forward basis. So a lot of these companies are trading like value stocks when it comes to price to earnings multiple and price to cash flows. And it's just mostly been the environment for a lot of these names, right? It's just not been the environment for a lot of these growth stocks. So, all right, let's see here. So is it true that institutions like Berkshire Hathaway get a higher dividend payout from companies like Occidental? I'm not sure. I don't know. I mean, they're a shareholder just like any other shareholder in that company. So I would assume they're only getting that 1% dividend. I don't know why. I don't see why they would get a higher dividend payment. They are one of the largest shareholders, no doubt. But if that's the dividend payout for the shareholders, then I don't see why they would be getting, like, let's say a 2% or 3% versus other shareholders getting 1%. I don't think that makes sense. So I would assume, yeah, and I believe that that's about as much as what Warren Buffett is also receiving from Occidental as any other shareholder in this company. So, but anyway, so NASDAQ here, more or less coming down to a break-even point, only up 17 basis points. The S&P 500 is up over 43 basis points, and we got the Dow Jones up over 0.5%. So now we're starting to see a little bit of an intraday sell-off for growth and a little bit of tech names, and value starting to hold up a little bit better. So if you come down to Dow Jones, Dow 30 names, you'll notice that the ones that are pushing higher are Walgreens, one of my dividend stocks. We got Procter & Gamble, we got Merck, Walmart, Home Depot, UNH, Visa, Johnson & Johnson, all of them pushing up here, with Amgen, Nike, IBM, McDonald's, Coca-Cola, Apple pushing up. The ones that are down are Cisco, Caterpillar, American Express, Boeing, JP Morgan, Intel, and then slightly Chevron. Chevron's more or less flat here on the day so far. So yeah, we got about 18 minutes till we listen in on what Jerome Powell and all the other senators have to say. And I'll do like an audio check once it gets started. But yesterday was good, so hopefully it works well today too. So let me know if you guys have any questions about any specific companies, right? Any specific stocks, any specific companies. What are you trading in this environment? Any questions about options? Any questions about just anything? Kevin says I'm gonna nibble in on some AMD today. So AMD is about $82. Right now $82, $83. I think that's still a decent support for AMD. My fair value is sub $80. Being around $80 is where AMD starts to make a lot of sense. I mean, even at these prices, I mean, the P multiple is just really low for this company. So I'm thinking about either selling a cash secured put on this stock or just straight up buying it at $80. I think cash secured put would make a lot of sense because you can get some very good premiums on AMD. So I did a video, right, on 8 cash secured puts. AMD was at the top of the list. I think the return collateral was about 12% if you go out to January. So, if you're looking at puts and you're looking at $70 strike, I mean, this is just insane, right? $70 strike, you're getting $7.20 in premium. So your actual cost basis after assignment will be in the $63 range. So you do that $7.20 divided by 63, that's almost 11.5% return in under 6 months, in under 7 months. You can't complain about that. That's just an insane, return collateral. So, okay, let's see here. LABU. So LABU, last time I checked, I think it was pushing higher on the day. So slightly up, 2.75%. XBI is the one to really be looking at. We're once again getting tagged to that 50 EMA. So if you take a look at where XBI is, we are at that support again. So this is the green rectangle for XBI. That's the biotech ETF, right? So we are over here at that support. And we're just getting bought up from those levels. And right now we're just getting rejected at that 50 EMA. If you get a breakout above $73, $74, if you get a breakout above that 50 EMA, then there's a possibility for LABU to also break to the upside and LABD to really come down significantly. And for us to continue that trend lower, for LABD to come down, LABU to continue to push higher. So the one that I'm really keeping a close eye on is XBI. And if it starts to see some more momentum to the upside. Okay, let's take a look here. So Oscar, when the market is falling as quickly as it has done already recently, how does that affect your already aggressive fair value of the company's example, Meta? Well, so the way the markets really work, in my opinion, is, it's always a pendulum, right? You have to, and I've done this in my previous videos as well. The markets go extremes in both directions, right? It goes to an extreme level to the upside when things are very euphoric and things become very, very, there's a lot of easy money and, there's a greed factor in it also. So markets rally and they do go to an extreme level in terms of valuations, in terms of prices, in terms of levels that people thought that never we would see. But it's the same thing that happens on the flip side as well, right? Extreme levels also happen on the downside. They all also happen on when we go through these sell-offs, and instead of greed, fear kind of takes over, and it's just like a pendulum that keeps swinging left and right to extreme levels. Very rarely you'll find the markets trade at about fair value, all stocks trading at about fair value. There's always going to be dislocation for the markets, for the companies, because no price is really perfect. And that dislocation could be on the upside, stocks trading at way above their valuation, their fair value, and stocks trading way below their fair valuation as well. I mean, take a look at Baba. I think Baba is a prime example of a company that remains undervalued, and it has been undervalued for so long, right? It's been, 2 years now? Last time it got up to that all-time high was October of 2020. So this October will be 2 years since Baba, is down about 65%. And I think we can all agree here that if you look at Alibaba on paper, if you disregard all the regulatory risk and whatever your views are on China, just think about the company itself, Alibaba. It's undervalued on paper, right? Its fair value should be much higher, and of course, the return potential is much higher given the growth in e-commerce and revenue and cash flows and all that stuff. But this is where patience really plays a bigger role in investing than your expectations. The expectations may not come true next year or next quarter or next month. It just depends on what your strategy is with that stock. If you're patient enough and the company executes the way you believe it's going to do and you're conservative with your estimates, then why wouldn't a quality company go back to where it was or where it deserves to be, right? So that real value is still there. It's just the market's sentiments change and the price are changing every day. So that's my 2 cents on companies that are selling off, that are trading way below their fair value or might be undervalued or discounted in this market. So you can still trade options in the market. That's what I've mentioned. In the meantime, I think trading options is a better way to go, because investing in this type of environment is that you're buying, and it's like throwing money into a fire pit, where every time you buy, the market just drops another 15%, another 20%, another 5%. So it just obviously keeps selling off further. Let's see here. So Gina says, why to buy if we believe we are going lower leg on SPY in July? Well, nobody knows that. Nobody knows the markets are going to be lower in July. I mean, if we have an expectation that the CPI print's going to be much worse in July for the month of June than it was in June for the month of May, then sure, the markets can see another leg down, but nobody knows that, right? Nobody can predict exactly if the markets are going to come down. So for me, it's a little bit of a different strategy that, yes, dollar cost averaging and buying in smaller quantities, not being super aggressive. Even though prices are lower, they can certainly go down even further. The one indicator that I'm really watching is inflation. I think that's the one that's leading right now, because the Fed is completely dependent on it. And then other indicators are really the prices of individual items. That the checklist that we created, the spreadsheet that we created, which is electricity, piped gasoline, which is what you use for cooking. Then we got actual gasoline, which is what you use for driving. Fuel oil. Those are the 4 items when it comes to energy. And then under food items, looking at some of the bakery stuff, some of the dairy items, meats, poultry, some of the grocery stuff, tomatoes, like sugar. Those are some of the things that I'm really paying attention to. Prices on a month-over-month basis. If they start to roll over, then not only some of the goods inflation is going to come down, excluding food and energy, but also those items as well. So that's when we start to really see inflation roll right back down and stabilize. But if that situation doesn't improve, then unfortunately the Fed will be in this illusion that they can fix inflation even though things are out of their control when it comes to energy and food. And the chances of a potential recession keep on increasing further. So that's where we are. Okay, let's see here. Let's see. So Voyager Digital, what is wrong with it? I think it might be a crypto stock, right? If I'm not mistaken, Voyager Digital. I think I've heard of it once. Let me just add Voyager Digital as well. I think it is a crypto stock. Okay, so this one, I think this is the one. So VYGVF. VYGVF. VY. I thought I had it right? So VYVGF. It's not showing up. Isn't this the ticker symbol? Okay, wait. VYGVF. What a weird ticker symbol. Okay, so this is the one. So I honestly, I don't have any information on the company. What is? I know it's in the crypto space, but unfortunately, I have no idea in terms of the fundamentals, the revenue, and whatnot. But if you take a look at across the board for a lot of crypto names, I mean, they've all been sold off, right? So as Bitcoin started falling in November of 21, you'll see that a lot of individual companies, whether it's Coinbase, whether it's Mara, whether it's Riot, CleanSpark, and then the Grayscale Bitcoin Trust and the BITO, which is Bitcoin Strategy ETF, they've all just been sold off. And then I think Voyager is in a very similar situation where obviously now it's to a point where it's trading at 60 cents. So yeah, very, very small market cap. I mean, it's about 119 million market cap. This is not something that I would personally be interested in to begin with, even if it was a regular company, non-crypto. It's just, market cap. I always prefer market caps at least 2 billion, if not more. Very rarely will I go below $2 billion market caps for companies that I choose to invest in. But even then, it has to be at least over $1 billion. Nothing below $1 billion in market cap. And then of course, when it comes to OTC stocks as well, you have to be really, really careful because over-the-counter, smaller market cap, micro caps, they're more susceptible to manipulation when it comes to just institutional buyers and sellers kind of stepping in. Because think about it, $115 million market cap, right? This stock can literally move with a one single button, right? Institutions can go in and buy shares and move it up and then sell or dump or whatever. So you have to be very, very careful when it comes to market caps. You have to have some criterias. Couple things to always look for: market caps at least over $2 billion. And volumes, always, the liquidity needs to be there. So always look for liquid companies, volumes that are at least over 1 million shares. So those are some things to really be watching. So yes, let's take a look at PayPal here. Where are we? So PayPal is at around $72, $73. So that right there is going to be that $70 range for PayPal. By the way, we got to keep check on the time. Somebody got to remind me if let me see here, Seeking Alpha. Somebody got to remind me if we're starting, right? So, all right. So one thing that I did want to point out for PayPal is PayPal's earnings growth is a lot better for the future than where it is for 2022. So let's just go over to PayPal Holdings earnings expectations here. Let's see, earnings estimates. So let's see. Okay, so the next couple of quarters is definitely a lot worse, right, for PayPal. So, we're looking at least a 23-24% pullback in earnings, like a decline year over year, 87 cents. And then we're looking at about negative 12% decline here on a year-over-year basis for the third quarter. So second quarter and third quarter will be bad, right? That's something that we have to accept for PayPal. But starting fourth quarter, the expectations are at least a 3.3% increase. That's moderating. And then starting 2023, that's when we start lapping over some of these worst numbers: 25%, 29%, 25%, 20%, 20%, 19, 26, and 21. So that's the expectation for PayPal. And, this is the revenue for each quarter: 9%, 14%, 14, 16, 16. So revenue growth and earnings growth, let's just go over to annual. They are a little bit bad for this quarter and for a couple next quarters. But starting 2023, they're a lot better. And this is the EPS estimate for PayPal. And if you take a look at 2022, 15% decline in earnings, right? $3.90, 15% decline. But moving forward, starting 2023, 23%, 21%, 24%, 32%, 25%. And if you take a look at the forward P for those numbers, I mean, we're now trading at 15, 12, under 10, over 7, 6, 4. I mean, these are just insane numbers. And then you take a look at the revenue, good mid-teens, high teens, even as high as 27%, 12%, 14%. So the point that I'm trying to make is that a stock that may look really bad in the short term over the next couple of quarters or maybe the next year doesn't necessarily mean that it's the end for that company, right? Yes, we're going through a lot of headwinds when it comes to potential recession, e-commerce sales slowing down, advertising slowing down, payment flow, payment orders, transaction volume, everything is going to slow down significantly in 2022 if we enter a recession. It might even be in 2023. But that doesn't take away from the fact that eventually there's going to be a time where things do start to normalize. And a lot of these companies do start to kind of bounce back higher as earnings start to grow and we get those year-over-year comps. Much better revenue also starts to increase once again for a lot of these. So I think Meta, PayPal, Amazon, a lot of these, Google, even AMD, Nvidia, Tesla. I mean, a lot of these stocks that are down 40, 50, 60%. Not saying that all of them are trading at super low valuations. I think valuation is important, but a lot of them are getting hurt on their short-term guidance, which is the next couple of quarters, which is going to be very cloudy, but doesn't take away from the fact those secular growth tailwinds for the companies 3 years, 5 years, 7 years out. So, all right, 3 minutes till Powell. We'll listen in here and see what he has to say, and then we'll see how the markets react to it. And as soon as it starts, I'll do like an audio check, and then let me know if you guys can hear that or not. But Tesla here now under 700, just down a little bit over 2% right now. We got Amazon more or less flat. PayPal here down about 12 basis points, so more or less flat here. Google is also flat, just over 12 basis points. We got AMD down about 1.6%. Nvidia is all the way down here, 160 is down about 1.5%. Apple still green, up over 60 basis points, and Meta is slightly down about 40 basis points. So NASDAQ up 32, S&P up 34, the Dow is up 40. So all three indices more or less flat, consolidating, and we got the 10-year yields down about 3.86%, just trading over 3% right now. We got all oil stocks selling off. Occidental is the only one that's pushing higher. Cybersecurity, all of them are green very nicely. CrowdStrike definitely having a day, up over 3%. And then we've got some other retailers here. Macy's is the only one. Macy's been selling off quite a bit. I mean, every time I've checked the retailers, Macy's the only one that's been selling off. So there we go. Last 3 to 4 days, it's just been selling off quite a bit. And from November 21, it is down about 49-50%. Been on a consistent downtrend overall. And it's one of the retailers that's just been selling off quite a bit, not able to find solid ground. And then we've got everything else pushing higher, with Costco leading, up over 2.7%. Walmart's up almost 2%. Home Depot, Walgreens. We picked up some Walgreens at about $40 just a couple days ago. Dividend yield is just insane now, almost 5%. The lower the price gets, the higher the dividend yield is. So, dividend yield now sits at about 4.7%. So definitely getting a nice bounce from $39, $40 for Walgreens. Yeah, I was gonna say it's almost 1 a.m. Where are you watching from? 10 a.m. Yes. So a couple seconds, it should start. And again, we'll keep a close eye on the NASDAQ. So that's going to be at your top right. This is going to be the S&P 500, bottom right. The 10-year yields are going to be over here, but I know that my face is also probably around here. So the 10-year yields, and then I will have the Fed speech over here at the top left of the screen. And let me know if you guys can hear the audio. I'll turn this microphone off, and then I'll turn on the other one. So we should be all set. It's going to be a very similar routine as yesterday. We'll listen in for 30 minutes, maybe an hour. No promises though. And then we are good. We are good to go. We'll see how the markets react to it. Yesterday during the meeting, the markets were definitely pushing higher. Intraday, we did see a bit of a strong rally. But of course, intraday, then we started to sell off. Another thing that I did want to point out before we get started here is the amount of spam comments in the comment section of YouTube, right? Even in my videos, I check, and man, oh man, it's getting a serious problem. Like, I do apologize for you guys. I know it's not the best experience, but I try to delete as many comments as possible, but they keep popping up. There's so many bots. They just keep, just rushing to your channel and just commenting so many things. It's such a headache, like seriously. So one thing, if I can ask you, is that just report those comments. Usually they're about like Bitcoin or something. If you hear anything about like a advisor like promising like insane Bitcoin returns, just report that comment. And there's also another spams now started with some Spanish written, so I'm not really sure what that says or what is that, but it's just a lot of those. And then we already know the third one, which also happened in our live chat yesterday, which is obviously not appropriate for me to say right now, but report those comments if you see them. I try to delete them as much as I can, but they're like all over. They like for one comment I delete, 3 more show up. So it's like 1 step forward, 2 steps back for me. It's like they just show more and more just show up. So it's a well-known issue and how ineffective YouTube is against it. Yeah, I mean, and again, YouTube is one of the obviously the largest platforms when it comes to social media. So I'm sure they've got a lot of things to focus on, but yeah, this has just been such a hassle. Mario says, "That's not you." No, of course not. No, absolutely not. So yeah, please be super cautious and alert about those. All right, how long are we gonna take, Jay Powell? All right, there we go. So I'm gonna play this audio. I'm gonna shut myself up, so let me know if you guys can hear this.
This Congress. Welcome, Mr. Marstadt, who's joined us before, and thank you for your years of public service and elective office in Nebraska and the work you do on with flood insurance and other things. Flooding is the most common, the most costly natural disaster facing our families and businesses and communities all over the country. Climate change only makes it worse. Last week, as Senator pointed out,
I don't think Jerome Powell is on yet. I don't think he's going to be on for a long time. I think he's talking to somebody else right now. So I don't think it's worth our time listening in on this right now. I don't know what you guys think. Just let me know. But I'll take a look who's talking. And if it's not Jay Powell, then I don't think it's worth listening in. Again, I'll keep a close eye. It's already open on my end. I'll see who's talking, and if it's not Jay Powell, then obviously just we can talk about the markets and individual companies and whatnot. But but man, you guys are funny. You guys are real funny. When we were doing this live stream yesterday, I was having a really hard time keeping a straight face and trying to listen because you guys are so funny in the live chat. See, they've already started. Like, it was just such a hard time keeping a straight face because you guys have the best commentary, the funniest commentary, I should say, about the whole meeting. So, but anyway, so let's see. Bitcoin just over 20,400. So again, just more or less consolidating sideways here. Omni says bring the spam back. Trust me, you don't want the spam. It's just really, really frustrating. And we got Ethereum here, just a little bit over 1,100, so just over 5% today, so not bad. Strong move for cryptos today. Actually, it says trying to entertain you. Yeah, I know. I know, but it definitely is. NASDAQ up over almost 1% now, so definitely having a nice move to the upside. QQQ here. So back up to 283. So 283 and TQQQ, which is a levered ETF, also pushing higher here, up over 2.6%, so just under $25. So I think this week, like I said, a technical bullishness, technical sort of a little bit of momentum to the upside was warranted, given how oversold we have been, or we were over the last couple of weeks. But again, starting next week and the weeks in July, I think it is going to be interesting because we're going to get those unemployment numbers, GDP numbers, and of course the FOMC meeting and inflation numbers as well. So Star 87, Fortinet had a split, 5-for-1 split. So that's why we're seeing the price trade as low as $55. So they had a split for 5-for-1. That's why they're trading at these levels. So Arjel, my take on Mara or crypto in general. Crypto right now is going through a very, very tough time. It's down over 60-70% overall. So, you're seeing a lot of individual companies just, perform really poorly. I mean, Coinbase is down over 80%, Mara is down over 80%, Riot, CleanSpark, I mean, all miners, all crypto, anything crypto related is unfortunately down in this environment. So, so if you are in crypto, that's the type of volatility and risk you have to understand going into it in the first place, because it's what crypto is known for, right? It's volatility. If anything, crypto is known for is volatility, right? There's going to be 60, 70, 80% drops in crypto overall. So you have to understand that risk is always there. So for me personally, obviously a very, very small allocation, less than 3%. Yes, it definitely sucks quite a bit. It definitely hurts. But crypto has been like this, since it's got started, right? It's had like 4 or 5 different 70 to 80% drops overall. So Bitcoin 20,000 is where we are at. If we do break down even further, if we see another sell-off, if we see some more accelerated selling pressure here, then unfortunately the next support is going to be sitting roughly at $13,000 to $14,000 for BTC, and resistance obviously all the way up to 28,000, 29,000, which is obviously a long ways away right now. So yeah, I'm just seeing the Senate meeting here. Still no Jerome Powell in sight. Mr. Toomey is talking right now, but still no Jay Powell. So FTX, I'm not sure what's going on with FTX. I don't think they're a publicly traded company, but I've heard about them in our Discord as well. Is it this FTX token? Yeah, like I said, I have very little information about different types of coins when it comes to altcoins or just different coins in general. I know that FTX is kind of like a broker in this space for crypto. But I haven't really taken a look at that company all that much. Cash to good puts on NVIDIA or AMD. So AMD, I think, has very strong yield when it comes to return on collateral. If you're looking at $70 strike or $65 strike, really depends on where you're comfortable owning 100 shares of AMD. I think we have taken a look at NVIDIA as well. NVIDIA has also got some very good premiums. So if you're going out to as far as January 2023, and I get this question a lot, that why are you going out to January, right? Why don't you just go out for 1 month or 3 months or 4 months? Why all the way till January? Well, if you think about it, it's start of a new year, right? Obviously, but the way I look at it is return on collateral, right? What is the percentage that you can generate on your collateral, on your cash, right? That's your cash on cash return, pretty much, is what you're getting. And instead of doing monthly puts where you have to, where if the option expires worthless and you keep the premium, you got to write new ones, and on a month, on a best case scenario for companies that we're going over like NVIDIA, AMD, some of the larger cap tech names, on a best case scenario, you can get maybe 4%, right? 4% per month. And if you do that over and over again, depends on the markets, that obviously is going to be a much better return if you do it every month. And and you don't get assigned. Option expires worthless. But instead, if you look for 6 months out or 7 months out, like in this case, we're looking at January, and you can do 12% or 14% or 16% return, cash on cash return, then even though your collateral is locked for that time, right? So in this case, for buying AMD or NVIDIA or whatever the stock is, your collateral is locked. At least you know that that collateral is generating you 15% or 20%. It's no different than putting your money into a bond and that's paying you whatever 10%, 15% return. Yes, with options there is risk. So obviously there's significant risk, selling puts on AMD or NVIDIA. The biggest downside risk is if the stock obviously sells off much lower than your strike and you're deep in the money, then obviously you'll hold on to an unrealized loss after your cost base is adjusted. But that's why the strike prices are so important, right? That's why you have to really look at the strikes and where you're comfortable owning that stock, right? You have to buy 100 shares. Sooner or later, you will get assigned. So you have to go in with that mentality that, okay, I'm comfortable buying 100 shares of this stock at this price. And if that's the mentality that you're going in with, then, selling puts or selling covered calls can be very, very lucrative. And yes, you can also roll out the option as well. So definitely, I think that's also an option available that will generate even more net credits to you. So for NVIDIA, if you're looking at, let's say 120 or 115, they're paying you $7.35 or $8.60, which is not bad. To 760, divided by 115 that we're looking at, right? So we're gonna subtract $7.60, so just call it 108. We're looking at about 7% return, which again is not bad till January. January is 6 months away, 7 months away. 7% in this market is not bad. That's if option expires out of the money and worthless. If you do get assigned, then of course you're going to hold on to 100 shares of NVIDIA at about $108, $107 per share, which again, you have to think about it, right? Cost basis wise, that would be like an insane deal. And the same same example that I went over with Tesla, $400 strike. I think we went down to like $360 cost basis, which is like an insane price for Tesla, in my opinion, for all the growth that it has to offer in the future. So yeah, I think in a selling market, in a market that's selling off, we're in a bear market and we're down 20-30%, and a lot of stocks are down 40-50%. That's a very lucrative way of owning shares of a company and getting paid while you wait. So anyway, so I'm gonna share this link in our Discord right now, so that everybody can watch this Senate meeting if anybody's interested. Right now, there's no sight of Jerome Powell right now. So, Naredi, yes, Webull should offer options rollout. Yes, they do. Robinhood offers it. Webull offers it. So yes, you should be able to roll out your options. But yes, I'm gonna share this link with everybody if anybody's interested in watching it. But that's where we are gonna probably end our live stream because Jay Powell is nowhere to be found, at least not right now. All I'm seeing is Mr. Brown, Chairman, and Mr. Toomey. So if he does show up, then definitely I will mention it in our Discord as well. So once again, thank you so much for joining. I really appreciate it. As always, make sure that you drop a like and of course subscribe if you are new to the channel here. We talk a lot about fundamental analysis, technical analysis. No, I'm watching it right now. Stan Lee, I'm watching it literally right now. Jay Powell is not speaking. So yeah, there's no Jay Powell in sight. I'm watching it right now. You're just getting me to stay. Stan, I'm watching it right now. Jay Powell is not talking. It's literally okay. This is the Senate right here. It's Mr. David Mustard who's talking right now. So Nitty says Powell is on. How? What live stream are you guys watching? On CNBC. Okay, let me just check CNBC here. Okay, Lori says he's on. Okay, I'll check. Okay, let's see here. I'm on CNBC Live. Guys, come on. You're Oh my god, no way. I'm watching CNBC Live too. Okay, so this is CNBC Live right now. Here, let me show it to you guys. This is CNBC Live right now over here, and this is the person that's talking right now. So that's CNBC right for you. Oh my god, Yahoo now? I gotta go to Yahoo Live? I know he's not talking. You guys are just trolling me right now. He's not talking. Okay, so I do see CNBC's one live stream that says Powell testifies to Congress on the economy and how the Fed plans to fight inflation. We'll wait. There's a couple ads running on this YouTube live stream. We'll wait. Just gotta wait another 14 seconds. There's an ad running here. So this is the one that is on CNBC's YouTube channel. Oh, there he is. There he is. You guys weren't joking. Let me see if I can bring that up.
Highs and wage growth elevated.
Okay, you guys are right.
Past 3 months show 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. A box in the June Monetary Policy Report discusses developments in employment and earnings across all major demographic groups. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and price stability for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials, like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. With inflation well above our longer run goal of 2% and an extremely tight labor market, we raised the target range for the federal funds rate at each of our past 3 meetings, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. In May, we announced plans for reducing the size of our balance sheet, and shortly thereafter began the process of significantly reducing our securities holdings. Financial conditions have been tightening since last fall and have now tightened significantly, reflecting both policy actions that we have already taken and anticipated actions. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy. We will make our decisions meeting by meeting, and we will continue to communicate our thinking as clearly as possible. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty in what is already an extraordinarily challenging and uncertain time. We're highly attentive to inflation risks and determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you very much, Chairman Powell. Chair Powell, at your Senate confirmation hearing, you were asked about the possibility that inflation is being driven by corporations in concentrated sectors of the economy. You said, and I quote, "That could be right. It could also just be, though, the demand is incredibly strong and that, they're raising prices because they can," quote unquote. We're all seeing and feeling the effects of inflation on consumer pocketbooks, but corporate profit margins are not hurting. In 2021, the profit margins of the S&P 500 index surpassed 12%, the highest profit margin on record, and is expected to be even higher in 2020. Corporate greed and consolidation are driving higher and higher prices for consumers above and beyond any inflationary pressures. Just last quarter, Tyson Foods, which sells 1 out of every 5 pounds of meat sold in the United States, claimed that their higher prices are due to rising labor and freight costs. Yet, they still managed to net an additional $500 million in quarterly profits. When it comes to rents, a corporate landlord recently remarked, and I quote, "We have an unprecedented opportunity to really press rents on renewals because the country is highly occupied. And so, where are people going to go? They can't go anywhere. We have a tremendous opportunity to press both on renewing leases for existing residents and to reset market rates, which we've reset numerous times, even this year," end of quote. This kind of blatant profiteering on the backs of hardworking families is simply outrageous. Could you elaborate on the role that corporations play in setting prices and how that is affecting inflationary pressures today? Would you also elaborate on what you meant when you said perhaps corporations are raising prices, quote, because they can?
Sure. So matters of concentration in the economy represent a series of interesting questions that are largely not settled. For one thing, it is clear that our economy has become more concentrated, largely due to lower levels of formation of smaller businesses. That has happened. It is not at all clear that there's a connection between a more concentrated economy and, for example, inflation. And of course, matters of corporate concentration are outside the jurisdiction of the Fed. Those are for the competition authorities and really not for us to discuss. In terms of why prices are going up, I think a lot of it has been, a lot of the places where prices have gone up quite a bit have been situations where supply is constrained and demand is very strong. And so take cars, for example. The demand for cars went up a great deal during the pandemic. People wanted to ride in cars rather than public transportation, and they wanted to move to the suburbs and things like that. Rates were low. The economy was stronger than people expected. But the companies couldn't really make more cars because they couldn't raise their output because of the lack of semiconductors. So when demand hits fixed supply, what happens is prices go up and margins went up. And so I think as the economy returns to normal, we would expect those profit margins to return to more normal levels.
Well, Chairman Powell, the example that I gave of Tyson, who said their prices were rising because of labor and freight costs, and yet they managed to net an additional $500 million quarterly profits.
I apologize. I'm having a hard time hearing your words. I'm sorry.
Okay. The example that I gave of Tyson Foods and the fact that they said that their prices were rising due to labor and freight costs, yet they managed to net an additional $500 million in quarterly profits. How do you explain that?
I'm not familiar with their profit and loss statement, but I will say, and again, there may be particular industries where there are competition issues. I don't know that. It's really not our focus or our authority.
Well, do you have the opportunity to look at rising costs and identify corporations where they are gaining substantial profits, yet they keep raising their prices. Do you have a way of examining that?
I think we can see that, but I think, you know, our job is to keep, you know, maximum employment and price stability. So we're not in the business of regulating individual companies or determining whether their actions, for example, are anti-competitive or that sort of thing. That's more for elected people and also for the competition authorities. So we do look at that. But again, I think a great deal of the price increases that you saw were a matter of supply being unable to meet demand, and the result was prices moving up. In many cases, that was the story.
Thank you very much. The gentleman from North Carolina, Mr. McHenry, who is the ranking member of the committee, is now recognized.
Well,
for 5
thank
minutes.
you, Madam Chair. I would, on this debate about corporate profits, I would commend to the committee Secretary Yellen's statement where she rejects the idea of corporate greed is to blame for inflation. And I concur. We have a complex set of issues. The fiscal house was certainly different than monetary policy. And the extraordinary nature of the partisan American Rescue Plan and the $2 trillion injected into a recovering economy and Democrat policies to keep people out of the workforce for longer than the rest of the Western world also contributed to inflation. So that is a political debate here on Capitol Hill, Chairman Powell, and that is on the political side. What I want to ask you about are the policy tools that you are using. Now, certainly you, as chair of the Fed and the Open Markets Committee, took extraordinary measures in the midst of the pandemic to ensure that we didn't have further contagion, and including extraordinary lending facilities, purchasing securities, keeping the federal funds rate at zero. These were the right tools at the right time. On the fiscal side, you had to partner with bipartisan bills to keep our economy afloat during government shutdowns. But like all the good firefighting measures, we should put them away when times change. I want to talk to you as you put these measures away, how you expect the economy to respond. So let's start here. What is your level of commitment to fight inflation?
Well, so it's unconditional, our commitment is. And the reason is that we need to, in a particular situation, we have a labor market that's sort of unsustainably hot, and we're very far from our inflation target. We really need to restore price stability, get inflation back down to 2%, because without that, we're not going to be able to have a sustained period of maximum employment where the benefits are spread very widely and where people's wages aren't being eaten up by inflation. Really, it's something that we need to do, we must do. In order to have that kind of a labor market, we'll need to do it.
So as you pull back these emergency measures from COVID and you normalize rates to what they look like sort of in the long run, how do you expect the economy to respond?
So when we raise interest rates and also to a lesser extent when the balance sheet shrinks, what happens is rates go up across the economy and financial conditions generally tighten. And you can think of it as in interest-sensitive spending is an important place that'll be affected, and that's things like automobiles and other durable goods. If rates are higher, then demand for cars will moderate, will decline a bit. The second channel would be asset prices generally. We don't target any particular asset prices, but higher interest rates tend to bring them down broadly. That tends to mean a little bit less spending out of because people's wealth has perhaps declined a little bit. And the third channel can be the exchange rate, where that also has disinflation effects. So overall, we have these effects on the economy. Our intent, of course, is to bring inflation down to 2% while preserving a strong labor market. As I've mentioned, that has become significantly more challenging with the events of the past few months, particularly the war, which is driving gas prices up and raising energy prices and also food prices and disrupting supply chains further.
So at the same time, you have a massive balance sheet. First begin with mortgage-backed securities. As we have a roll-off of the Fed's balance sheet of mortgage-backed securities, what are expectations for how that affects housing?
So I think what will affect housing is the rate. The housing industry and market are slowing down from a very, very hot pace. And that's partially because of higher mortgage rates. The effects of shrinking the balance sheet will be marginal compared to the effects that we're seeing and expect to continue to see from rates rising mortgage rates.
But what are your expectations and any further announcements? Can we expect further announcements on the assets you hold and the securities you hold? Or are there going to be balance sheet announcements in the coming weeks?
No, I would say this. We have a plan. We've articulated it. The markets are forward-looking. They see it. And the markets are in a good place, I think, understanding what we're going to do. And that's, we're going to be allowing these securities to mature and run off our balance sheet at a pace that we've said. And it'll be 90 or 95 billion, I guess, by September. Now it's about half of that. So that's what we've done. And we expect, the idea is that that'll just be on an ongoing basis in the background. And we think the markets can handle that. Treasury issuance is way down. So we think there will be demand for these securities. The Treasury will then reissue them in whatever form they think is appropriate when it relates to treasuries. So
Thank you.
The gentleman from New York, Mr. Meeks, who is also the chair of the House Committee on Foreign Affairs, is now recognized for 5 minutes.
Thank you, Madam Chair. Mr. Chair, it's good to see you. And I know you'll hear a lot of probably political stuff going back and forth. But the American public is trying to understand the language of which we're talking today so that we can really understand what inflation is. Fact of the matter is, I just recently was over in Europe. There's inflation in Europe, just like there's inflation here. Although, as I talked to Christine Lagarde and others, they say the cause of the inflation may be different. So if the causes are different, they said that maybe demand here, but not a case of demand there, is to resolve inflation in Europe. For example, I was in Moldova, 30% inflation rate, gas $15 a gallon, Turkey 80% inflation rate, gas $13 a gallon, and I could name places in Europe from Europe to the United States. Is it that we had, whether it was the supply chains, the China shutdown, complete shutdown, the zero COVID policy, Russia's war in Ukraine, COVID period, isn't just a massive storm of everything is what contributes to inflation and causes it all over the world?
pretty much, yeah, that's pretty good.
It's a little bit of everything, right? So if I'm talking to my constituents, trying to explain to them what inflation is and what causes it, I would not single out any one thing. I would probably have to talk about the conglomerate of things, because if you take away 2 or 3 of those things, we might not be in the situation here. All of it unprecedented, all of it really out of the control of anyone. Out of control of Democrats, out of control of Republicans, out of control of the president, out of control of other governments. Is that not correct?
Some of it is out of our control. For example, the price of oil and most of the price of food. And to your point, Europe has much more. It's much more about energy and food prices. Very difficult problems, and also they, of course, have the European Central Bank has different countries, which and so they have to worry about the difference, the spreads between different countries, and that's a different challenge that we don't have here. We have the difference here for us is we actually have a very strong economy and well-recovered economy, and so more of our inflation is from demand, and we do have tools to deal with demand. That is the place where we actually can work, and that's what we're using our tools.
And some of that was because during the crises that we had to do certain things, stimulus and other things to make sure that we kept our economy stable. I mean, without doing those things, we would have been in trouble. So the things that we did going through COVID, the stimulus, trying to make sure people kept their jobs, kept money coming in at the time, was what we had to do. Otherwise, we would have been in worse shape or not have as strong economy as we have now compared to other countries. Is that not correct?
Yes, I would say it this way, that our inflation is a consequence of very strong demand, in part driven by supply, by what Congress did to support activity, in part driven by what we did, but also...
But that helped stabilize our economy at that time, right?
It did.
And if we did not do those things, our economy may not be as strong as it is right now.
I think that's right.
That's
so
correct.
Our economy is strong.
And let me jump to something else real quick, because the one other thing, I know you testified before the Senate yesterday, and what concerned a number of my constituents that I talked to was the question about can we resolve inflation without increasing unemployment? Because our folks are concerned about losing their jobs and not being able to, it'd be worse if they were unemployed. So my question to you is, can you speak to what the Fed has seen during the last few years with respect to the relationship between unemployment and inflation? And is it possible that we can continue to have a strong labor market while also curbing inflation?
It's certainly possible that we can. And there is a relationship between unemployment and inflation. The challenge now is that inflation is at a 4-decade high, and some of it we can deal with. Some of it is really going to be dealt with on global markets, the price of oil and that kind of thing, and we can't affect those. But the challenge is we're tightening monetary policy, and that's designed to drive growth down to a level that's more sustainable and lower, give the supply side a chance to catch up, and give inflation a chance to come down and bring inflation down. That's what we're trying to do. We don't have precision tools, and we raise and lower interest rates. It affects the whole economy through many channels, and so there is a risk that unemployment would move up from what is a historically low level. Though a labor market with 4.1% or 4.3% unemployment is still a very strong labor market. Today's rate is 3.6%, and there are 2 vacancies for every unemployed person. So that's a labor market that's kind of overheated.
The gentlewoman from Missouri, Mrs. Wagner, is now recognized for 5 minutes.
I thank you, Madam Chairwoman. Chair Powell, thank you for joining us again today. I just want to start by saying how sick and tired I am of the president's inflation blame game. One day it's Putin's fault, another it's the oil companies and the meat packers, or perhaps it's corporate greed. Now we're blaming other countries like Estonia, Turkey, Europe. I give you my avid assurance that no one in Missouri's 2nd Congressional District gives a rip what the price of gas and groceries are in Europe. They care about what they are at the corner of Manchester Road and Weidman. No one in this administration is willing to accept responsibility for the dismal economic situation America is in today. Inflation, sir, more than tripled in 2021, from 1.4 to 7%. And from June to the end of September 2021, inflation hovered, I think, around 5.4%. And then began a steady increase until reaching an historic 8.6% that is now crippling Americans' spending power today. Chair Powell, when inflation remains steady at 5.4% during that period in 2021, what factors played into the Fed's decision to keep rates at nearly 0 during each FOMC meeting in June, in July, and in September of 2021, sir?
So during the summer of 2021, just giving us hindsight, inflation was coming down month by month. If you look at monthly readings for CPI or PCE, they were coming down month on month through September. And so that I think, told us that our thesis that this was going to be a passing inflation shock was at least plausible. I think that the data turned pretty hard in October and November, and we very much changed our position, and since then have tightened financial conditions quite significantly. So it was a matter of a few months when we were really looking at this and thinking it's going to be passing. Most macroeconomists thought that it would be a passing thing. It turned out to not have been so far, and so.
But we saw it move from 1.4% to 5.4%. So I don't, we did have a steady period of time. I wouldn't say that it was declining. But I'm just surprised that we weren't moving more quickly at the Fed. I mean, I want to be honest, sir, that the Fed, I think, underestimated actual inflation. What do you think you missed?
Well, we did underestimate it. With the benefit of hindsight, clearly we did. So it comes down to this judgment that we had to make. It has really nothing to do with our framework or anything like that. And every central bank had to make the same judgment, which was looking at the supply chain problems and, the shock to labor force participation, millions of people out of the labor force, we had to decide whether that was going to be a lasting thing or whether it would kind of turn around quickly. We had very high levels of labor force participation. Suddenly they're much lower. The thought was people will come back. As soon as COVID is over, we have these new vaccines. Every American is going to get vaccinated. We'll be done with COVID by the end of the year. So basically, these supply side issues, broadly speaking, just didn't get better. There were recurring waves, and that was the judgment we had to make. We knew it could be wrong, and I think when it started to look pretty wrong, we pivoted. And
now, President Biden continues.
Like 7 months ago.
President Biden continues to say that a recession is not inevitable, as his government agencies, and Dems in Congress continue to spend billions and trillions of taxpayer dollars, burden businesses with costly rules and regulations, and on top of it, the president refuses to unleash American energy independence. The president's policies continue to take inflation taming options, I think, off the table and hamstring the Fed's ability to focus on price stability. President Biden not only limits the energy production here in America and spends trillions of our taxpayers' money, but he also threatens tax increases and promises to cancel billions in debt. How can you still say, sir, that the Fed has a pathway to a soft landing for the economy?
Well, that's our intention is to achieve inflation getting back to 2%, and
with all I've laid out,
a strong labor market. I'm sorry.
With all I've laid out, and the increases you're going to have to take.
So as I mentioned, I think that path has gotten more and more challenging, thanks to the effects on oil prices and food prices, really, and also the supply chains from the war in Ukraine. It was never going. We never said
Not
it was
just
going to
the
be
war in
easy.
Ukraine, sir.
Well, it's the rise in energy prices and the rise in, which has been, began in the latest rise from February.
The latest rise. This has been going on for a year and a half. I appreciate the chair's indulgence. I will yield back the balance of my time. Thank you, Chairman Powell.
The gentleman from Texas, Mr. Green, who is also the chair of the Subcommittee on Oversight and Investigations, is now recognized for 5 minutes.
Thank you, Madam Chair. Thank you for being here, Chair Powell. I greatly appreciate the opportunity to have a few thoughts with you, share some thoughts. In February of 2021, you indicated that millions of people were out of the labor force, which is what you said today, millions. And with millions of people out of the labor force, the Biden administration and persons on my side of the aisle sought to do something about that, to help those who were unemployed. The inflation that my colleagues speak of has to do with unemployment, the help that we gave people who were unemployed at the time. Persons who are unemployed, Mr. Chair, they need help. They can't feed their families. Small businesses were screaming for help. We helped small businesses to get through a turbulent time. This was a pandemic. The vaccines had to be distributed and developed. That's a part of that inflation that they're speaking of. People needed rental assistance. People were literally going to be evicted by the millions, but for the assistance from the Biden administration and Congress. We wanted people to go to work. We provided some child care. If you want people to go to work, schools are closed. You got to help people through these turbulent times. They never talk about what the inflationary costs that they speak of really did, how it benefited American people who were suffering. They overlooked that. They weren't going to help, and now, since they didn't help, they're going to say everything that they can to demean the help that was given. Now, they didn't vote for it. They don't extend the hand of friendship to people in times of need. So when they don't do that, they have to find a way to denounce the help that was given. It's really shameful. It's painful, and it's sinful to hear people use a term, inflation, to indicate that people who were unemployed shouldn't have received help. The small businesses that were begging for help shouldn't have been helped. Vaccines shouldn't have been distributed. People shouldn't have gotten rental assistance. They shouldn't get child care. Now, I would respect them if they would say these things, that these are things that they opposed. But they're not going to do that. They use one word, inflation. And unfortunately, our messaging to all of the American people has been somewhat lacking. But I want the people that I serve, who pay attention to the supermarket more so than the stock market, to know that when they needed this help, we were there for them. And Mr. Powell, you indicated that there were millions of people out of work in February of last year, just prior to this help being accorded people. I welcome your commentary.
I'm sorry.
I welcome your commentary.
You welcome my commentary. Sorry, I didn't catch the last part. So, you know, our job is maximum employment and price stability. We did what we did during the pandemic, acute phase and response, and you did what you did, and now we are where we are. And so we have a job to do, and it's very important that we do it, not least because of the people you talk about. The people you talk about are really suffering from inflation now at the grocery store, and the only way we can get back to that, get back to a place where inflation is low again, get inflation back down to 2%, and help those people, is by trying to get demand and supply back in balance.
Let me intercede and say this. You said something that I find favor with. You said, we did what we had to do. We did what we had to do. We did what we had to do. We were the adults in the room who did what had to be done. Others who declined to do can now be critical. I yield back.
Thank you very much. The gentleman from Minnesota, Mr. Emmer, is now recognized for 5 minutes.
Thank you, Chairwoman Waters. Thank you for holding this hearing, and thank you, Chair Powell, for your testimony and your time here today. Financial freedom is American freedom, and frankly, Americans do not have the financial and economic freedom they need to invest in themselves, their businesses, and their families. Unfortunately, Americans are too busy making ends meet to focus on anything else. Inflation is running rampant across the United States, with consumer prices rising 8.6% in the past year, the largest price increase since 1981. From fuel to meat to housing, my constituents and all Americans are suffering at the hands of this hidden tax, except it's not so hidden anymore. It's punching Americans in the face, as my friend Mr. Stile put it yesterday. So how did we get here? It's pretty simple. We gave up American energy independence. We locked down our citizens and businesses for nearly 2 years, pumped the economy with well over $5 trillion in what's called stimulus funds. And now, as we recover from the pandemic, we simply do not have the energy resources necessary to meet the increased consumer demand. There's a history of Democrat policies we can point to that put us in this position, from refusing to adopt an all-of-the-above energy strategy to recklessly passing $2 trillion in partisan spending through the American Rescue Plan, despite the fact that nearly $1 trillion of bipartisan relief was unspent. But the bottom line is we need solutions now, because inflation is beating up the American people. We have to wake up and realize that we cannot continue these spend-your-way-to-prosperity policies. Everyday inflation threatens the financial security of American families, of our constituents. We need solutions. Let me just return to my point about the spending. In December 2020, we'd authorized nearly $4 trillion in bipartisan COVID relief. Yet just 3 months later, Democrats pushed through another $1.9 trillion with hardly any oversight mechanism included, even though a quarter
a quarter of all COVID relief remained unspent. When President Biden was recently asked if the $1.9 trillion spending bill caused inflation, he said he didn't think the bill had even a minor impact and called the idea, quote, bizarre. Chair Powell, do you agree with the president's conclusion that the $1.9 trillion that was included in the American so-called rescue plan had not even a minor impact on the inflation we're seeing today?
I'm sorry, I wouldn't comment on what any elected official said, and it's really not up to us to score fiscal interventions.
Again, sir, if you would, respectfully, I'm not asking you to comment on what the president said. I'm asking you personally, do you believe that the $1.9 trillion American Rescue Plan did not even have a minor impact on the inflation we're seeing today?
We didn't comment on the Tax Cuts and Jobs Act. We didn't comment on the CARES Act, and we won't comment on that act. From that,
it's interesting, sir. It's interesting, sir, that you won't comment on this, but you were more than willing a year ago to talk about inflation as some transitory something that everyone has acknowledged now. It's going to be here for a while. Even though it seems like the president's Build Back Better package, this massive spending package, is dead on arrival, certain elements might not be dead. Chair Powell, do you have concerns that if Congress injects a new round of stimulus into the current economy, it could, and in fact will, add to the inflation we're seeing today?
Again, really, it's not our role to give you advice on what to do. You know, we report to Congress, not the other way around. We're sticking to our mandate and our mission, and we have a lot of work to do on that front, and not really giving you advice on what you should be doing. We take fiscal policy as something that comes to us, and we deal with it as part of everything else.
I'm very disappointed, sir. I mean, you are supposed to be in charge of the monetary policy of this country. You're now embarking on raising interest rates because that's the only tool you think you have left. This is not just a dog chasing its tail anymore, sir. This is a dog that's starting to devour its tail and its back end because of the debt that we are carrying. I want to thank you. You acknowledge we're in a bad spot. We're knowingly walking toward an even worse inflation, a recession, and God forbid, food shortages. Yet we're relying on old monetary policy tools to keep us from falling off a cliff. Sure, we can raise interest rates over and over, but the only way to curb in a disaster this bad is to raise interest rates to a catastrophic level, or as like Larry Summers suggested, we allow unemployment to go to historical highs. It's not feasible. We need to put ourselves on a strict spending diet, and we have to have strict oversight on the funds that Congress has already allocated to make sure not even one single dollar is going to waste. And we need to put control back in the hands of small businesses on Main Street. Thank you.
The gentleman from Connecticut, Mr. Himes, who is also the chair of the Subcommittee on National Security, International Development, and Monetary Policy, is now recognized for 5 minutes.
Thank you, Madam Chair. And Mr. Chairman, if you'll indulge me 1 minute. It's important for the American people to understand what's being said here today, because it's being said in other rooms in this building. What the American people are seeing today is something that my Republican Party friends have given over to recently all too often, and that is rank dishonesty in the service of acquiring and retaining power. A party without any resilient or discernible principle has stumbled upon inflation. There's inflation all over the world. Germany, Japan, Africa, South America, the United Kingdom. There's inflation all over the world. But the Republican Party has decided that inflation is Joe Biden's fault, or the American Recovery Plan's fault. I've read the monetary policy report from start to finish. It gives the Russian invasion of Ukraine, supply chain bottlenecks, high fuel costs, high wage growth. It does not mention Joe Biden or the American Recovery Plan. By the way, the American Recovery Plan is a particularly rank piece of dishonesty. Set aside the fact that it cut childhood poverty in half. As Mr. Green pointed out, if that isn't something to celebrate and to perhaps have the slightest bit of humility as you attack it, I don't know what I can do for you. The American Recovery Plan, as Mr. Emmer pointed out, was about a third to a quarter of the fiscal efforts that this Congress made on a largely bipartisan effort to lift our economy to the point where it is today. The chairman said strong and well recovered. Unemployment at 3.6%. So many jobs out there that many of them are going unfilled. Did we overshoot? Maybe we did. But the American Recovery Plan, this thing that cut childhood poverty in this country in half, was about a quarter to a third of the fiscal efforts. The other money was supported by President Trump. But by the way, it's not those dollars that are still sitting in Americans' bank accounts. It's not CARES dollars. No, that was supported by the Republican Party. It's only those dollars in the American Recovery Plan that cut childhood poverty in half. Energy prices. I read the monetary policy report. I'll quote it. Because of the Russian invasion of Ukraine, oil prices rose sharply. I've been around here long enough to know that putting facts and truth out is like spitting into a hurricane, but it's important for the American people to understand that. Mr. Powell, I released yesterday, I hope you got a copy, a white paper on a central bank digital currency. It's offered with humility because we have a lot of issues to work out, but I hope you've had a chance to take at least a quick look at it. I wonder if you have any reflections, or importantly, what are the next steps now that you've gotten commentary from lots of people? What's the next steps with respect to the Federal Reserve thinking about a CBDC?
So I did have it. I printed it out. I have it here. I have not had a chance to read it carefully, obviously, given all that's going on. But no, so I think generally we're doing a great deal of work. The president signed an executive order, and administration, parts of the administration are working on this. I think it's something we really need to explore as a country. It should not be a partisan thing. It's a very important potential financial innovation that will affect all Americans. And, our plan is to work on both the policy side and the technological side in coming years and come to Congress with a recommendation at some point. And we don't prejudge what that would be. I know your views are very positive on it. But I think one thing I did see in your report was the beginnings of thinking about how Congress might authorize it. And I do think that's a very, very important aspect of this, and it's great to have Congress starting to think about that.
Thank you. I think I agree with that, and I think that has bipartisan support. In my remaining minute, I'm going to ask you a question I ask you a lot, Mr. Chairman. We're obviously seeing pretty dramatic swings in the financial markets. Money is no longer free. We're seeing that in the SPAC market, the high yield market, the equity markets, cryptocurrency. In my very short remaining time, Mr. Chairman, what should we be focused on? What is concerning you with respect to systemic risk that may develop in the face of rising rates and rising inflation?
So, basically the financial markets have been functioning well, and the banking system in particular is very strong, well capitalized, lots of liquidity, better understanding and management of its risks. The place where there have been issues, and we don't see them elevated at this point, has been illiquidity in some markets relative to where it had been historically. But
any markets in particular where you worry about illiquidity?
No, I wouldn't say that we're seeing anything that's particularly concerning. But I think sort of systematically, liquidity in the Treasury market has come down from where it was, and we've been looking for some time at ways to address that. But the markets are clearly functioning reasonably well.
Thank you. My time has expired.
Thank you. The gentleman from North Carolina, Mr. Budd, is now recognized for 5 minutes.
Thank the chair. Chairman, thank you again for being here. Congressional Budget Office.
All right, everyone. So I'm actually gonna take off here. So I'll share the link for the Senate. Definitely a lot to digest. This is a lot more heated than what we saw from yesterday. So again, I'll do a summary video, everything that is discussed in today's meeting, in today's testimony from Powell. You'll get an update, like a full recap. But I'll share this video. I'll share this link for everybody who wants to continue watching. And I'll do an update as well. Market's doing, much better. Nasdaq's up over 1.3%. But again, this was the same trend from yesterday, but we ended up closing flat. So it really depends on where we end up closing. That's what all that matters. S&P is up a little bit over 80 basis points, and the Dow Jones is also pushing higher, 172 points, up over 0.5%. So once again, thank you so much for joining. I really appreciate it. Make sure that you drop a like. I'll share the link in our Discord for you guys to watch further. And also check out the links down in the description for our Patreon and our Discord as well. Happy investing, and I'll see you guys first thing tomorrow.